Good afternoon, everyone. I think I should begin this panel session with a confession. I remembered when Clement approached me about 1 or 2 months ago, and when he told me that the topic for this final panel discussion would be navigating the post-pandemic regulatory landscape, I was a bit skeptical. Well, I didn't tell him. I just kept it to myself, and I was trying to be polite. I was a bit skeptical because I thought to myself, well, look at the other topics. We have double circulation, we have green finance, we have fintech. So who cares about regulatory landscape? We are always, we are market players here. I believe most of the audience are market players and people from the industry. So you would be more interested, I suppose, to things which are happening out there. So what we're doing within the closed doors behind the IA, I just don't understand why we are going to choose this topic. But after hearing this morning's discussion, and in fact, I noticed from the second polling question, the results of the second polling question, after noticing that result, I think I must be wrong. And actually, the polling result has proved me wrong. Now, if I may just read that question out again, and it goes like this. What do you think is Hong Kong in insurance industry's competitive edge in the GBA market? Choose up to 2. And I'm looking at the online version, online version results. And answer E came first, robust legal and regulatory regimes. The robust legal and regulatory regimes scored the highest mark of all of this, all of the 5 answers. So clearly, most of us would agree that having a robust and strong legal and regulatory framework is the most important or most competitive edge for the insurance industry in Hong Kong. And I know, and I suppose that the question doesn't have the definition of regulatory bodies or regulatory framework. But being the organizer of today's event, I believe we, as the IA, we have the prerogative to have a slight interpretation leaning slightly towards the IA. So I suppose the credit should go to IA. So I envy your wisdom, Clement, in devising this panel discussion, saving the best for the last, if I may say so. Now, if I may begin with a slightly more serious note, I think for the past 2 years, we all agree that this is a most unprecedented time for all of us. And the insurance industry is no exception. And I would have thought that, we always say that a lot of things which used to be unimaginable, beyond our imagination, have all happened. And we conveniently describe them under the description, the new normal. And everybody has different definition of what is meant by new normal. And this morning, our chairman, Moses, gave us a very comprehensive definition or interpretation of this term. And we have been, as a board member in NED of IA, I always have a feeling that we're like a watchman standing at the top of a watchtower, paying close attention to what's been happening over the past 2 years in the midst of the pandemic, with the market players on one side and with the consumers or policyholders on the other side, and looking at how they interact with each other in the midst of all these challenges and difficulties. And I would have thought that those who will be in the best position to give us an overview of what has been happening over the past 2 years, and also to give us a projected view towards what will happen after the pandemic, must be our executive people, Clement, Peter, Carol, and Simon, because they are the ones who have been rolling up their sleeves day in, day out, doing all the donkey work. and helping the industry and helping policyholders at large. So without further ado, can I perhaps begin with Peter? Because Peter, you are the market conduct guy, and we are now talking about regulatory landscape. And looking back over the past 2 years or so, are things really that quiet or less vibrant in terms of business activities? And what are your observations on the impact of the pandemic on the general standard of the conduct of the market players? Can you share with us on this?
Sure, Samuel. Thank you for the question, and thank you, everybody, for staying around for this final panel. It gives us cause for cautious optimism, and I think that's really the tenor of how we see the post-pandemic regulatory landscape. And we see it like that mainly because of the two major trends that have impacted the insurance market throughout the pandemic. And I think the first major trend that we've observed is there has been this growing sensitization of consumers to risk and to the risk to their health caused by the pandemic. And that's been coupled with an enforced inability to travel, which has meant that consumers in Hong Kong have had the time to do those things which they've been putting off for a while, like revisiting their financial planning and their insurance needs. So because of that, we have seen a demand for insurance protection in the local market in Hong Kong. And that has been complemented, of course, by the insurers and intermediaries being forced to really focus on the local market because the borders being closed. So you've had a situation where insurers and intermediaries have done better than one might have expected in a pandemic situation of this sort. And in fact, you know, we've seen from the figures a rather decent bounce back in the life insurance market. We've heard anecdotally that some intermediaries have also done very well. From a regulatory standpoint, that's been really good to witness because it's that market dynamic which has caused, if you like, a raising in conduct standards. Why? Because the insurers and intermediaries have had to hone their selling skills on Hong Kong consumers who, frankly, are the most sophisticated, and by sophisticated I mean demanding, consumers in the world, at a time when those consumers are demanding insurance protection. So you have seen the market operating to raise those standards, and we see better standards of fair customer treatment and customers making informed decisions. And our own guidelines and codes, which are very principle-based, have provided a great platform for that to happen. So that's the first trend that we've seen. The second trend that we've seen is the one which has really been spoken about today, that really enforced acceleration of the adoption of technology by insurers and intermediaries in the way that they deal with their customers, in the way that they service their customers across their operations and in their compliance systems. And that, of course, has driven greater efficiencies and in the speed and quality of delivery of service to customers. So as we stand on the cusp of the, hopefully the cusp of the border opening up and the beginning of the post-pandemic regulatory landscape, we have reason to be optimistic, because it's as if the industry's been in the gym for 2 years and has come out lean and hungry and at its fighting weight, ready to serve the pent-up demand on the mainland, which of course has also been stimulated by this growing sensitization to risk when the border opens up. So we're in quite a good place from a regulatory point of view. But there is no room for complacency. So from our perspective as a regulator as to how we deal with that situation is certainly in market conduct, we're going to see a lot more focus on conduct supervision going forward. Our story in the pandemic has been, we've been focused very much on the deemed licensee process and honing our own fintech offering in getting those licensees processed. And at the other end, we've been getting our enforcement processes and disciplinary processes. Those are now up and running, and we're running on a rhythm of about 1 disciplinary panel a month. But going forward, it's the middle part, conduct supervision, that we're going to be focusing on. So you'll see that coming probably in 3 strands. There'll be a lot more focus on what the key person in control function for intermediary management has to do. That's the first thing. The second thing, inspections. We've been doing a fair few inspections on brokers, but we're also going to be included on the inspections for insurers as well, and there'll be a larger conduct focus in those inspections. And thirdly, and I think probably most importantly, is we're going to place a greater emphasis on the culture and the ethics in insurance companies and intermediaries and in the way they sell business. And we've started that already in some of our inspections, and it's an interesting thing that we're doing. We're picking things up that we perhaps wouldn't have seen before. So I think that's where we are. We're cautiously optimistic of where we are at the moment, with a greater focus on conduct supervision coming and a focus on culture and ethics.
Thank you, Peter. Now, you mentioned sensitization of the consumers, greater appetite for insurance products, protection needs, and you also mentioned what is expected to be a pent-up demand as the border reopens. And this morning, I think our CEO also alluded to possibility of having good news pretty soon. Now, can I then perhaps turn to Carol? I mean, every one of us, we are expecting and yearning for the border to reopen. And I think it's not unreasonable to expect that the demand will surge up. After all, we're talking about 86 million consumers, GPA alone, not to mention the other parts of the mainland. Now, and as the IA, I mean, as someone who is taking care of the life or life-related products, can you share with us whether there are any measures in the pipeline which will make sure that as the border reopens, as the demand surge, there will be steps put in place to make sure that the development of the industry will remain healthy, and also the interests of the policyholders will be taken care of properly?
Sure. Thank you, Samuel. So good to see everybody here still staying here with us. And I wish to, to talk a bit from the perspective of a regulator bringing the prudential supervision of our life insurers perspective. Simon has asked a very good question. So I will talk about what we have been doing in terms of acting as the prudential regulator during pandemic and also post-pandemic. In line with our IA's dual objective, if you guys still remember, is to protect the interests of the policyholder as well as to promote our industry. So we have been focusing on our supervisory resources during the pandemic in the following two mainstreams, namely the health check to ensure the resilience of our life insurers during pandemic and post-pandemic. And secondly, is we have adopted a free track approach to handle and to respond to the changing customer behavior, as what Peter just mentioned. For the health check exercise, we definitely, have done, like, apart from the usual dynamic solvency testing, we have included additional stress testing scenario, like, for example, credit spread widening scenario. Basically, is to test our resilience, the life insurance resilience in respect of their solvency and liquidity positions due to pandemic as well as the lower for longer interest rate environment. We have also, enhanced our assessment on the asset liability mismatch of our life insurers. We also enhance our supervision on the investment. So this is an area that draw our attention during pandemic and also post-pandemic. Apart from revisiting, the investment mandate of our life insurers, we have looked at the concentration risk. We have also looked at the investment governance, and most importantly is how our life insurers is handling or making proposal to mitigate the investment risk. So if we are talking about risk, I guess if you, insurance practitioner here, you definitely are aware that this year is the first year that the IA received the ORSA report, the Own Risk Self-Assessment Report. What does the ORSA report tell us? Not only it tells the current key risks that our life insurers are facing, it also identified the emerging risks, especially post-pandemic. So therefore, we have been very vigilant in reviewing these ORSA reports, the key risks, the stress testing result, as well as the management actions, proposed management actions, the viability of these proposed management actions. So in summary, we will definitely deploy all the above health check tools when we are going into the post-pandemic era. Secondly, promote industry. I think Peter mentioned about this new normal customer behavior change towards a preference for the higher protection product. In fact, they are also longing for this simple product, but embracing digitalization. So with that, we have adopted a free track approach, namely the first check, the TFM, temporary facilitative measures, second check being the virtual onboarding using our InsurTech sandbox, and the third track, product innovation. To recap, the first check, we have introduced the temporary facilitative measures in February last year. Basically, is to allow the face-to-face distribution of certain high protection product, being QDAP, Qualified Deferred Annuity Products, and VHIS, so Voluntary Health Insurance Scheme, to be sold by non-face-to-face channel. In fact, the measures have been extended to the first quarter next year. That helps a lot in terms of facilitating the virtual onboarding of our life insurers. And then comes the second track. So we have looked into how we can facilitate the virtual onboarding of our life insurers for all kinds of long-term insurance products. So therefore, in August last year, we have issued this requirement, but we use it under the InsurTech sandbox. And in fact, a number of projects has, after testing, has rolled out into the life gradually. So the most importantly is when we are entering into the third track, where product innovations, we are working very closely, in fact, with our industry and also fellow regulators to innovate into products that can promote inclusiveness, address the protection need of the society as a whole, and most importantly, it is enhance the capital efficiency when we are facing the upcoming RBC risk-based management, RBC risk-based capital regime. So therefore, we are looking forward, to the launch of this protection-linked product, PLP. So perhaps I think my time is up, so I'll talk about that later on, a bit more later on, right?
Yeah. Sure, thank you, Carol. Now, Carol, you've mentioned about extra stress testing, risk assessment, so on and so forth. Now, as I was listening to you, I was just curious. I mean, if I were doing long-term business, perhaps, well, fine. I mean, because business is coming in. I don't mind doing, extra stress testing or extra compliance because business is coming in, especially in anticipation of the border reopening. But what about GI? What about general business? So can I come to you, Simon? I mean, could you just give us your feeling or your observation of the aftershock of the pandemic on GI and whether you are able to reassure the market players in the general business that things are not that bad post-pandemic?
Yeah. Thank you, Samuel. I was just, to prepare for this topic, I was actually trying to go back my memory lane on what happened these past 2 years. And one word I would use to describe my mood is roller coaster. And I jot down a couple of points just to share with all of you. As Samuel already mentioned, it was unprecedented time. And if we look at that 2 years, even though we were talking about pandemic, but what happened in these 2 years, we also have these social events, we also have this geopolitical development, which actually also affect the entire market. So the objective of us being insurance authority has always been try to make sure that the insurance market is healthy, is resilient, is able to withstand all this pressure. Insurers, they need to make ends meet. They need to write business, they need to pay claim, they need to invest for a return, and they need to produce profit for the shareholders. During these 2 years, all these 4 areas are under pressure. And there's also a new definition of what customer journey means and what do we mean by customer experience. So everything is being thrown in disarray. When it comes to the non-life insurance, I just quickly perhaps highlighted. The key is always to do with going back to the basic in managing the risks and underwriting discipline. Because this is a time when insurers are really feeling, in a way, the helplessness as to what does the risk mean to them. How can they cope with them? How can they price it? And the point mentioned by Carol on the OSA is very important. It's important not only because we have come the right time of a tool for insurance company to start to look at the risks. It comes at the right time for everyone to see actually risks are just next to us. And we need a common language to communicate to each other and to manage risks in its own right. So our business is about taking risks, pricing the risks, managing the capital accordingly, so much so that we can pay the claim as an insurer. So what better timing other than now for us to say that if you were to manage your company together with IA going forward, you need to have a tool, and that is the OSA report. That's the pillar 2 of the RBC that we are doing. So this actually helps to cultivate managing risk and capital as an attitude rather than a compliance requirement. And I think this is very important because, to me, it helped to draw a lot of commonality between the IA in prudential supervision together with the insurer in terms of trying to find a common language to cope with what we need to cope with. And based on what we have seen the past 2 years, we have a long road ahead in terms of going forward. So I think that's a couple of key points I would like to share with the audience. Yeah.
Thank you, Simon. Now, well, both Carol and Simon mentioned, or seems to suggest that OSA comes really timely because of the pandemic. Now, Clement, I saved the best for last. Can you tell us, is it really the case that when we talk about ORSA or ERM or RBC in general, is really that timely, or are you simply trying to pacify the market players?
I'm not sure whether I'm the best, but I'm certainly the last. But anyway, in the interest of time, and I want to make sure that we save some of the points that we wish to make for the second round of questions. First, I need to clarify, I'm here not as a CEO. I'm here in my dual role as the Executive Director for Planning and Development. This is a role that I play concurrently, just like Peter, until a suitable and affordable replacement is found in the market. So those of you who are poaching people from us, listen to this. I just want to make sure that I use this time wisely. Samuel, you asked at the very beginning about why we have this session. In fact, we had this session 2 years ago, in 2018. At the time, I must admit that it was because that we had a time slot, we didn't know how to use it, so we put in a session like this. But with that session, I think 2 years further, we believe that it's useful because it's useful to be a chance for everybody to understand why we do certain things. You might not agree, but that people deserve to know why, and they deserve to know where it leads to. Because I think the essence of regulation is, in fact, to induce correct behavior, like Peter said, and to maintain the right behavior and to further that. So this is a good chance. Of course, for some of you, it's the payback time, so you have score to settle in the last 2 years. You have the Q&A session, so whatever you don't like, tell us. Now, Samuel, I wish to use this time to perhaps describe a little bit about what happened in the last 2 years. I think that will give a lot of background to the things that my colleagues have said before. To me, the last couple of years has been a time to borrow the same concept. Simon said roller coaster. I say it's exciting and enlightening. I say this because it's 2 years of huge change. We see change in all fronts. We see change in customer behavior, we see change in insurers' strategy, we see changes in the regulator's philosophy. With customers, with all these other panel discussion, you can perhaps recall that we are having people who are more conscious of the risks, who have more time to browse the website about information, and therefore we have an explosion of demand for personal protection products, and mainly of a local origin. Now, this comes at an interesting time because of the social events and COVID. We have a total shutdown of mainland Chinese visitors' business, which in fact comprised 1/4 of our new business 2 years ago before everything started. So it's an interesting change. And now with that comes flexibility. People want to do things at their leisure. They want to do it 7/24. They want to do it, a different bite-sized transaction. So technology comes in, and they want good customer experience. Now, insurers, to a certain extent, responded to that. They design new products, and they pour investments into digital channels. I must emphasize, it's not about replacing intermediaries. It's about enabling them. So we're seeing both investment into digital direct platforms, as well as investment into automating the selling process, plus the compression of the back office procedure, which in turn provides better cost control as well as customer experience. And finally, there is a huge trend towards using data analytics as well as partnerships between non-insurance entities. We're seeing insurers reaching out to traditionally unlikely partners simply because there's less business to be found. So insurers actually have a sea change in the way they do business. Now, how do regulators respond? I would say, Samuel used a very, very shrewd analogy, watchtower. We watch, but we have to act. So as a regulator, I believe sometimes we have to lead, sometimes we have to follow. Sometimes we direct, and I think sometimes we respond. We can't just do one, we have to do both. So in this sense, I think we've done quite a few things. Carol talked about product innovation to follow on cue that we're trying to do a PLP. She talked about providing temporary facilitation measure. It's not so temporary. It's done. We've done it for 1.5 years. We invented the term inside the IA just to make sure we feel more comfortable. We call this alternative compliance. So you are still complying, but we're just not doing it the same way. So we have our own internal struggle in the IA about all these. In the same way as we grant the license to the virtual insurers, we don't know what you're going to do, but we hope that you're going to solve some problems. So this happened, and they talk about OSA and all these is because we want to shift from curative to preventive. You see Peter talk about how we maintain you in a gym condition when you come out, Carol talked about OSA, and Simon talked about how they prevent these underwriting performance to be mistaken to be a sustainable situation, and therefore you have to maintain underwriting discipline. All these basically are the same kind of philosophy. We're trying to move our regulation forward into a preventive mode. OSA allows that. And we also have institutionalized that into a company review process, which are now in practice, first by Simon, then by Carol, soon to be by Peter as well. That means if you do well, you see us less. You know what I mean? So if we start calling you very often, you must know that something's not going right. So we invest our resources according to what we believe are the higher risk areas. And we do not try to punish people, but we try to guide them. Maybe with a slight, dent in your record, but we mean well to make sure that you have a process that we can do a review every year. So you have a year to right the wrongs, and we can then adjust our resources accordingly. So this is something that we are trying to do. And finally, on the RBC, although we didn't mention that very specifically, the pandemic in the last couple of years made us the process of designing the RBC a lot more robust and pragmatic. Basically, what I was trying to say is that we have got the best stress testing ever possible on this particular regime. It's an important regime. We are falling behind international best practice, but we have been able to backtest everything that we do on the RBC regime against the data in the past 2 years. Look at the financial market, look at the interest rates, volatility, look at the equity market. You'll know that by backtesting in the last 2 years, we wouldn't have produced anything which is not pragmatic and not be able to survive in a long-term basis. So I think, Samuel, that's in a nutshell what I wish to say.
Yes, thank you, Clement. I think I really like the way you describe this shift from curative to preventive, and it seems that this is something which is a common thread through different aspects of whether the industry or our work as a regulator. Now, Peter, can I return to you now again in this context? I mean, this shift from curative to preventive. Now, just now you've mentioned about, if I understand correctly, a shift from taking enforcement or discipline action to conduct supervision and building up a culture or skill set for the market players so that the policyholders will be treated fairly. Now, can you perhaps shed a bit more light on this? I mean, in terms of what the RA may roll out in order to help industry build this culture that will be able to treat customers fairly and which will be geared more towards conduct supervision rather than, being punished if they don't do it right.
Sure. So that's absolutely correct. When you think about our new regulatory regime, what lies at the heart of them is these new conduct requirements. And these conduct requirements are really ethical principles, treating customers fairly, putting the customer's interests first, acting with integrity. These are encoded into the ordinance, and all persons who are carrying on regulated activities or persons who are selling have to abide by these principles. That's as it should be. Insurance is important. It's a product which everybody should buy, and people need to be able to trust the persons from whom they are buying insurance. And that's why these principles form the foundation, I would say, of the insurance market. And it's incumbent on every CEO, every responsible officer, every key person to model these principles in their everyday behavior, and also to filter that down to their staff and the intermediaries who represent them. So if there's one way to prepare for conduct supervision, it's that. But if I was to get more specific and identify 3 things that you could prepare for with regards to conduct supervision, it would be these. Number 1, complaints handling. Now, I know after a day talking about fintech and green, complaints handling is not that glamorous, but it is vital. The way in which an insurer or intermediary handles a complaint against them tells us so much about the culture and ethical practices of that insurer or intermediary. And really, it sets an insurer's and an intermediary's reputation for trust. That's when you're engaging with the customer directly when they have a problem. What we ask all insurers and intermediaries to do is to handle complaints against them in an objective and impartial manner. And we know when that's not happening. We know it. We see it when the complaint's happening. We can tell who's handling in an impartial manner and who is not. So it's absolutely imperative to ensure that that principle, impartiality and objectivity, is embedded into your complaints handling. Number 2, I would say, is training. Now, training, as you know, the CPD requirements have been changed this year. They've gone up from 10 hours per year to 15 hours per year. And there are 3 hours that you have to do on ethics and regulation. And it is imperative that all insurers and intermediaries ensure their technical representatives and agents meet those CPD requirements. Yes, we have a penalty framework for those individuals if they don't, but it's on you as the principals to ensure that they do. And again, if they don't, it says a lot about your culture to us. So that's another thing that we'll be looking at. And on that, if I could perhaps demonstrate, Mr. Moderator, some ethical selling practices, the IA is here to help. We have come out with our own ECPD course on ethics and regulation, which will give you those 3 points to comply with the ethics and regulation requirements under our CPD framework. And that will be coming out either really, really late this year, I'd say as a late Christmas present, or early next year as an early New Year present for you to, a good New Year's resolution for all of you would be to do that ECPD course. So watch out for that. The third thing would be, you would have seen, I would hope, our new newsletter, Conduct in Focus. It's in there that we highlight some of the trends that we see in the complaints that could weaken the culture in the insurance market, has the potential to do it. And so you can focus on those things and fix them before they do become problems. We've highlighted things like a collection of premium by agents. That's something that every insurer has to have proper controls in place on. The other thing is orphan policies. That's another thing that we've highlighted, where our complaints have shown a root cause of where orphan policies have not been looked after properly. So again, these things talk to culture and the ethics of an insurer. So remember our ECPD course as a Merry Christmas present to you all. Thank you.
Thank you, Peter. Peter, you mentioned some Christmas present or New Year gift. Now, let's move away from market conduct regulation, but still on this idea of a shift from curative to preventive. And back to you, Carol. I know that there's something very, very close to your heart in terms of innovation, in terms of what the market should do in order to close the protection gap that has been existing for quite some time. And I think recently we also have a presentation on this very important finding. Can you share with us very briefly on that?
Or perhaps, can you allow me some time, to just, just now our panelists have shared the views on the past 2 years. Think of a single word to describe. Can you give me 1 minute to talk about that?
Sure.
Well, I'm just trying to, fly back to, to the 1st of April 2019, where we first launched our QDAP, Qualified Deferred Annuity products. So I'm thinking, that was right before the social events and right before the pandemic. So if not, we have launched the QDAP. If not, that we have launched the temporary facilitative measures in February last year, being pressured by our chairman to get it done in February, so that, then otherwise, and also get the virtual onboarding facilitation through the sandbox to be done in the middle of last year. Our life insurers cannot survive through, this pandemic because of this closure of the border, having 1/4 of the new business from the mainland visitors business, we lost the 1/4 new business. But it's being sort of compensated by this, having the sale of QDAP and having the virtual onboarding on the sandbox being launched in time. So if you ask me what is the single one word to describe our life insurance situation in the past 2 years, I would say it's a narrow escape. So while we are losing 1/4 of the mainland visitors business, we have this QDAP and also the VHIS being sold through the virtual onboarding platform. And then later in the later half of the last year, we have other life insurance products being sold on the virtual onboarding on a sandbox basis. So back to your questions about this mortality gap. Yes, we have been riding on the very successful experience of QDAP, the launch of QDAP I just mentioned. In fact, it's been one of the innovative products that we launched in order to bridge the protection gap and to bridge the retirement gap as well. So if you recall this morning, I guess someone here in the panelists talking about the report that we have released, being for working adults, the mortality protection gap being 1.5 million. So in terms of bridging this protection gap, apart from the introduction of the QDAP on the 1st of April 2019, we are also working closely with the industry to develop this PLP, protection-linked product. In fact, during the development process, we have already incorporated, the Peter mentioned about his TCF, Treat Customer Fair principles. So therefore, the current product features of PLP, it embraces high and meaningful protection elements. There is simple and very transparent fee structure, and also it has confined fund choices, being it has the lifestyle fund as well as the ESG fund, they are there as well. This morning we mentioned about the ESG fund, right? And most importantly is, in fact, we have the PLP can reach the underserved customer sector, being the younger generation. So now the younger generation, if they can buy PLP to earn a decent return without having undue risk exposure, And at the same time, they can try to plan their retirement early as the age, like 20-something, 30-something. So if you're an individual, you want to plan your retirement early, and if you're at the age of 20-something to 40-something, so you can buy the protection-linked products. And if you're at the age of 40-something to 60-something, so the QDAP, the tax-deductible qualified deferred annuity product is definitely your choice. And if you're 60-something, we definitely have the life annuity products being provided by a lot of the market players here in Hong Kong. So in summary, I want to say is our life insurance industry, in fact, they are providing a range of products that can satisfy the need, the protection need, as well as the retirement need of an individual throughout his or her life cycle. So I really wish to point out this point, right?
Thank you, Carol. Now, Peter's Christmas gift is perhaps more for the intermediaries. And Carol mentioned another tangible Christmas gift in terms of PLP for the industry, and because of to compensate the business loss because of the closure of the border. Now, again, difficult job for you, Simon. For GI, what sort of Christmas present or words of encouragement can you offer?
This morning, we have a couple of sessions, and I was also listening to the speech of the CE. I think there, actually, if you look back, all the discussion about the GBA, the service center, the cross-border motor, the launch of the iOS, if we take a step back, all this happened actually over the past 2 years in the making. So I think one thing I want to highlight is the pandemic and all that, the social movement and also this geopolitical development might slow down, for example, mainland investor going overseas. But it will not, but it didn't slow us down in having the first cat bond being launched in October. It also didn't slow down the preparation of the IA as well as of the insurer for the future. So I think that is very, very important. Then early on, we have the FinTech session. And I like the words that are being used by the panelists to say, from fast to furious, from vision to opportunities, from being an edge to actually that it's a survival skills. With the orchestrations that we actually see that the market adoption is actually moving to that direction. And in the meantime, I just want to add, insurance is theoretically a very simple business for general business. You have a risk, you have the data, you have the statistics, you develop the pricing, and you come up with terms and conditions. But the difficulty is when it comes to all these risks that we are facing, you don't have the data, you don't have the statistics. So the pressure on the insurance market is always to do with how can you be quick in coming up with innovations and also product development to cope with the risks. And the additional pressure that most of our non-life insurers are facing is these societal expectations that the whole society expects that the risks that they are facing can be taken over by the insurance sector at a time when they are still trying to look for the solutions. So I think within these 2 years, some of the things that I think we have worked very well together with the market is, for example, a very strong collaboration with the Hong Kong Federation of Insurers in terms of educating the public on what risk means, what role can the insurance industry means to them. So I think these are all very, very good points. So our preparation for the future continues. So the core proposition remains to be the iOS, remains to be the reinsurance center, reinsurance hub, and also risk management center. And when it comes to the local market, the domestic market, is to do with the fundamental profitability, especially in those lines of business that we have already seen some signs of recovery based on the past efforts. So I don't know whether you will see that as Christmas presents, but I think that I would tend to see that as a solid evidence of the results of a concerted effort together with the industry in trying to find solutions to some of the problems that we have been facing amidst the highly pressurized situation under the pandemic, under all that situation, because it doesn't slow us down in preparing ourselves to solve the problem. That underscores the most important part of what is needed for the future, and that is resilience.
Thank you, Simon. Simon, you mentioned data. I think a number of speakers today also mentioned data or data exchange. Now, Clement, whether Christmas present or not, can you share with us what the IA is going to do on this front?
I don't think regulators never give out Christmas presents. But anyway, now, just to I think perhaps catch on what my colleagues have said, I think I'm a great believer in market forces, particularly in Hong Kong. So in my public life, I always see Hong Kong coming out with its best when we are faced with adversities, always. So I believe the role of the regulator, I talked about directing and responding. And I believe that we should be more responding than directing on most occasions. What we need to do is to set the right direction, that is to know what we want to achieve, mobilize the right partners, and find the best timing. And then the market will do the rest. So I think the process is not so much who rescue who. The process is how we communicate with trust and then find the right people, mobilize them, and at the right time to solve the problem that we collectively face. This is how we handle things. I believe if you look back, I cracked a joke earlier, John, with you and your young entrepreneurs, but when we look back on the virtual insurers, you have the answer. When we look back on QDAP, the criticisms about it not being able to sell, you have the answer. And I believe you're going to have the same answer with the protection link plan when it's launched. So we take risk, but we take a good risk. And we believe that we're taking the risk in resolving an issue for the public good. Now, with all these, thank you for giving me another chance, Samuel. We realized in the last couple of years with all these changes that one thing runs through everything, which is data. Today we talk a lot about data in the previous couple of panels, and we see a unique opportunities because all barriers has been lifted, some voluntarily, some by brute force, but everybody is willing to share because they see a greater common advantage. So the IA is now focusing on a project, which is in fact what we have been learning from the HAMA is open API framework. It's now already under operation in the banking sector, and we have formed a working group. We have 31 members. We're still recruiting, by the way. We are in the process of identifying use cases, which means pilot projects, in fact. Samuel, we're going to carry on this process in the second and third quarter with a view of promulgating 3 things by end of the year, including open API framework, including guidelines on ethics, including guidelines on outsourcing, so that we can have the foundation for a more vibrant ecosystem for partners of different sectors, as I alluded to before, some of which, in fact, are non-traditional partners from other sectors, to be able to join in. And in time, we're hoping to be able to access the CDI, the commercial data interchange, which is now being developed by HAMA, to provide even more alternative sources of data for people to analyze. Now, this is just the beginning. Data runs through all the other things. Simon talked about the ILS, maybe cat bond, maybe typhoon-based, any kind of NatCat-based risk transfer instruments has to be supported by data. So that needs to be done. It's not just a collection of data, it's analytics, so it's data modeling. Same goes for climate change, because climate change itself is fraught with problems in terms of how we define different kind of products and how we actually assess the risk of different products. So that is something which we have to come to that. And finally, data also runs through RBC because we are already in the process of consulting the industry on the regulatory disclosure requirement, which in turn will be the template for data inflow into IA. That eventually will drive RegTech and SupTech, which means how conveniently and how cost-effectively you can give data to us, and how effectively we can use the data so that we can bothering you with less frequency and get the right result. So data is everything, and data is, I think, something that will sort of permeate everything that we do probably in the next year, and perhaps we will have something to report when we next meet on stage in the Asia Insurance Forum.
Yes, thank you, Clement. So let's look forward to seeing how this data and CDI, or data exchange, will play out in the next year or two. Now, we still have a little bit of time. I'm not sure if there's any questions from the floor. Yeah, thank you. Actually, we've got quite a few. But because of the time constraint, perhaps I would just pick up one. Right. Now, here's this question. As regulatees, I think, we are always cautious about the regulatory or supervisory strategies of our regulators. Can the IA let us know what your coming conduct supervision focus will be? I think Peter has touched on this questions in your presentation. Is there anything you would like to add to that?
Well, I can tell you what broadly our. Let me answer that by telling you what our enforcement strategy is, so you know what to avoid from with regards, because in all honesty, the two do dovetail, right? So our enforcement strategy is really based on three principles. The cases that we prioritize are ones where there have been actual policyholder harm, number one. Number two, cases which show a real breach of ethics, so unethical behavior. And number three, cases which have come about through an inherent and quite drastic weakness in corporate governance. So that's the cases that we prioritize for enforcement. Conversely, that's what we're looking for in conduct supervision. Now, I'll add to that by saying I said there's an emphasis on culture and ethics as well. So we would want to look at from a quantitative and qualitative side. So things like on the quantitative side, we'd look at persistency rates, lapse rates, renewal rates, claim rejection rates, complaint statistics to get a sort of indication of what the underlying culture of the company is. But also, when we inspect, I think the most valuable thing is actually speaking directly to the management, and also going down the levels in the company, speaking directly to the agents and to the TRs. That's, I think, where we learn the most about the culture in a company. So I think that gives you an idea of what our approach to conduct supervision is and the kind of cases that we look at to prioritize on enforcement.
Yes, thank you, Peter. Now, since time is running out, and since we are now coming to the end of today's panel discussion, can I ask Clement, perhaps you to give our audience what you regard as the major takeaways for today's panel discussion? I'm not confining to this panel discussion, but perhaps to all four discussions. Now, you very humbly tell us that you are not wearing head of CEO, but you are the CEO. So, so over to you. Takeaways.
I think the takeaway is simply that insurance is not alone. And one thing that I actually told quite a couple of people that we try to do this year is to make people who are not from insurance sector to talk about insurance. That's why we brought in KC, we brought in the GFA, and I think we've done part of that. We should do more, because as I said before, Samuel, with this COVID, with data, with technology, the cooperative circle, the perimeter is being extended, and it's going to keep on expanding like the universe. I think that is something which I learned from today. I've heard a lot of things which I think will bring me some energy to do more work. But I'm now more willing, actually, to explore ideas with people who are not in the insurance sector. I think that will bring me to another level, and it will bring me to a level which I think can cultivate more fertile grounds for the industry going forward.
Yes, thank you, Clement. So, on behalf of the audience and everyone here, whether online or physically here, can I extend a word of thanks to all of you for sharing with us? And I have to say that after hearing your sharing, I mean, I'm more uplifted. We're talking about pandemic, and it seems that although I won't say the picture is going to be rosy, although we all want the picture to be as rosy as possible, but I'm sure that there are a lot of positive things to anticipate after the pandemic or when the border reopens. So once again, thank you very much.